Welcome to another video. My name is Tom, a former senior financial analyst, now a full-time YouTuber talking about financial education, stock market, and all that good stuff. In today's video, I want to answer a simple question. I get asked that a lot, especially during the past week. Is the bull market of 2020 over? Should we still get in 2021 if you want to start trading in the stock market? Or should we stay out because it's too late? Basically, is it too late to start playing in the stock market? And my answer is it's complicated. I made a video actually warning you about the potential crash of 2021. I told you a crash may come. Now that doesn't necessarily mean one is coming. It's just a tool for me to evaluate risks and mitigate against any potential crashes. Now in fact, I think there's a good chance the market still keeps going up in 2021. There's a good chance we're still going to see a bull market in 2021. So what I'm going to do in this video, first of all, I'm going to give you the answer first. And the answer is yes, you should get into the stock market in 2021 if you haven't done so. I believe there's a good chance to build your wealth and actually build a long, sustainable investment plan even in 2021. If you're not going to speculate, if you're going to do long-term investment, 2021 is no different than 2020. However, as I suggested in my previous videos, you have to be prepared for a potential crash. You have to be prepared for every possible curveball. And in this video, I'm not going to just give you the answer and saying, yes, you should. I want to show you how. If you haven't gotten into the stock market right now, or if you want to learn how to structure your portfolio in a way that's going to mitigate risks, but also not leave money on the table, basically will allow you to maximize returns and maximize your portfolios, then stick around because this is exactly what I'm going to do in this video. I'm going to show you how to properly structure your portfolio so you mitigate against risks, but also actually keep a lot of the upside inside. Now, I said it before and I'll say it again. If you're a beginner or if you don't want the hassle and the headache of actually managing your portfolio, just get an ETF of the S&P 500. An S&P 500 ETF will allow you to enjoy the returns of the market without any of the hassles. For example, last year, the S&P 500 did 15% without you touching anything. If you just put your $100,000 in an ETF of S&P 500, you made 15% last year by doing nothing. Now that kind of thing is not shameful. It's a good investment, it's healthy, it's conservative, and it's quite all right. A lot of people are ashamed to say that because they don't want to be Gordon Geckos playing in the stock market. Cut it out, come on. It's a good thing to have an ETF, no problem. However, if this isn't your less money, and you're willing to accept the risks that go along with the potential upside, in this video, I'm going to teach you how to allocate your money between the different types of investments so your portfolio is well protected, but also primed for the upside. Now, we know that 2020 was a crazy roller coaster. It went up, then it went down, and then it went up and never came down since. But here's something I'm going to explain about my methodology. And I know a lot of other people may give you different advice. I never ever will try to time the market. What I'm about to explain to you in this video is not about timing the market. It's not about day trading or swing trading. I do long-term quality value investing. For me, swings and jumps in prices are meaningless. That's how I operate, and that's how my methodology and my portfolio is built. If you're looking for day trading advice, this isn't the place for you. And the reason is quite simple. The stock market is a manic depressive drunk person. You cannot anticipate where the next step of this drunken person will be. He's wobbling around. The next step can literally be anywhere. There's no algorithm or any type of anticipation or science that can predict the next step of this drunk person. That is why timing the market is nothing more than gambling, at least in my opinion, and that's how I'm going to keep it. By the way, everything I say in this video is my opinion, should be treated as such, allegedly in my opinion, blah, blah, blah. Do your own research, and let's get to it. So here's my methodology, my system, if you want, on how to structure your portfolio. Let's say that I have $100,000 of available cash to work with. First of all, the first thing I'm going to do, I'm going to pick up $15,000. I'm going to take it out, put it in the bank. I want to have at least 15% liquidity on my assets. Whatever I'm investing, there's 15% of that sitting in bank for whatever reason. If I need anything urgent, I always have cash at hand immediately, no matter what. Okay, so now that we have $15,000 in the bank, the other question is, what do we do with the other $85,000? Now, it can be $85,000, but it also can be $850,000. It doesn't matter. We're really talking about percentages. So this is 85%. So first of all, I'm going to take another 15% and I'm going to put it in the ETF to track the market. So now we have 15% sitting in cash, another 15% sitting in an ETF of an S&P 500, something completely conservative, and now we have 70% more to give out. Now, these 70% are actually very interesting. I'm going to take 30% and put it in OGs, original gangsters. We're talking about the Coca-Colas, the Adobes, the Apples, companies that are safe, blue chip stocks for long-term investment. These are just as good as cash, pretty much, in my opinion. So which companies actually qualify as this OG blue chip stock? First of all, anything below $50 billion does not qualify here, not by a mile. I only go for companies that are 50 billion and above for this category. I also want to see profits and earnings for at least 3 years consecutively. I also want to see much more assets than liabilities, good management, good morals, and everything we talked about in my videos. There are 5 factors. These would essentially be the Amazons, the Apples, the Walmart, the Mount Rushmore companies of the world. These are the companies that qualify for these rankings. Otherwise, they go to the growth category. Now, these 30% I'm also putting to the side. Now, we have 40 more percent to play with, and here comes the interesting part. All of my 40% I'm going to put into high growth stocks. And by saying high growth companies, I don't mean penny stocks. This isn't gambling. This isn't speculating. We're talking about good established companies, but companies that have more upside than the regular companies, but also more risk. Disruptive companies, innovative companies, tech companies. And it's not always about the valuation. Tesla is one. It has almost $1 trillion already at this point. And then the M is one. It has 1.2 billion. The differences in valuations can be huge. The common ground is that these companies have a lot of upside, but also a lot of risk. Lee, Xpeng, Neo, all of these innovative companies people are talking about are companies that have a lot of potential, but also a lot of risk. Now, here's the thing. With these companies, you're not likely to lose all your money. You're not investing in penny stocks. So worst comes to worst, these companies can go down 20%, 30% in a horrible situation. But even in the case where they lose everything, even if the company goes to zero, you only lost 40% of your investment because 30% of it is still sitting safe. And another 30% is cash and ETFs. So you're good. No penny stocks, no gambles, and no options. I don't believe in options. Options are leverage. And leverage also means risks. I'm not a risky guy. I'm a conservative, risk-averting person. I don't like it. I like safe, long-term investments. So I don't do options. I don't do penny stocks, no swings, no day trading. It is what it is. And here it is, boys and girls. It's as simple as that. That's the secret nobody wants you to know. It's not complicated. It's not brain surgery. This isn't rocket science. It's as simple as setting clear rules, clear boundaries, being cautious, being conservative, and keeping your own rules. No cheating. If you go by the system, your hedge will actually protect you from any curveballs and will allow you to enjoy a lot of the upside of a bullish market. And hey, it's not perfect because if the market explodes out of the stratosphere even more, by being conservative, you miss out on a lot of the upside, but also you're much more protected. The other thing is, it's not certain. I mentioned this before. The only certain things in this world is that we're all going to die someday. We're all going to pay taxes, unfortunately. This isn't science. It's all guesswork and estimation. The market can go crazy. We may lose everything. Nobody really knows. Once you put dollars in the stock market, you have to be willing to live with the concept that you may have lost your money by doing that. If you're not ready to lose everything you have in the stock market, then don't get in. It's as simple as that. Now, I hope I simplified this for you just for the beginners. If you want more content like this, let me know in the following videos. I'll try to do more. As always, huge thanks for our channel members, our Patreons, people who've been buying our merch. Thank you so much. We'll see you guys in the next video.